For today's Chamber University, I'd like to introduce our presenter, Daniel LeaMon, Commercial Risk Advisor with Distinctive Insurance.
Hey guys, it's truly a pleasure to be here. I want to thank the Metro Chamber of Commerce for inviting me to be a presenter here on Chamber University. Today I'm going to be talking about ways to identify risk within your organization, steps to improve or implement a risk management strategy, and the awesome benefits of doing so. Now before we get started, I just want to talk a little bit about myself in regards to this presentation. So as Danica mentioned, my name is Daniel LeaMon. I've been licensed in property and casualty since 2014. In my first year, I worked with local brokerage focusing primarily on the assets and needs of families around Las Vegas, Nevada. In 2015, I joined a team of Distinctive Insurance where I work today. I operate as a commercial insurance broker, but in today's insurance market, I think agents need to bring a little bit more to the table. So I truly operate as a risk advisor with an emphasis on risk management. I help nonprofits and commercial entities in the construction, education, and medical industries conquer obstacles connected to daily flow. For more than 10 years, I've been involved with and/or responsible for elements of risk related to contractual agreements, compliance, regulation, and liability. I have a unique perspective focusing on the big picture, and I like to see the outcome before it's all started. One of the largest risks affecting Southern Nevada right now is the lack of medical doctors. So I joined the Roseman University's Breakthrough in Medicine campaign as an effort to improve the quality of life here in the Valley. Our goal is to raise $66 million to get our private nonprofit medical school accredited, staffed, and started. We're looking to welcome our first class of doctor students by 2019. The big picture, at some point, we'll all be patients. So as we go through this presentation, I'd like you to keep the big picture for your organization in mind. Let's go ahead and dive into Risk Management 101. So risk management is the ability to see the big picture. As a child, I would always tell everyone to put on their seatbelts as we got into the car and drove off. I wanted to make sure everyone was safe. I think it had to do with those crash test dummy commercials, and my imagination has always been pretty strong. So I could just see my family in place of those dummies, and it wasn't always pretty. But it really got me thinking about the dangers of driving. Putting on a seatbelt to reduce the severity of injuries sustained from an auto accident is a form of risk management. During the mid to late 1970s, property and casualty insurance premiums were discounted by up to 80% below market recommendations. This was one of the softest insurance markets in a 50-year span. The insurance market went through a correction period during the mid to late 1980s. This period saw insurance premiums rise by up to 60%, with increases typically lasting for the course of 3 years. This significant rise in cost gave way to the risk management movement. When companies could no longer purchase enough insurance to cover their risks, they started self-insuring and finding ways to control their losses. The chart on the right is meant to show as an example of a single company's insurance costs, market corrections during the noted time frames. We can expect that market swings of such large proportions won't be as common in the markets of today because of how effective big data is in helping carriers identify frequency and severity of losses. So let's go ahead and define risk. So risk in property and casualty is the threat of a loss occurring. A loss occurs when an item declines in value, and I personally classify it as when an associated injury is sustained. Because risk is the threat of something happening, that means that it hasn't happened yet. While risk is often perceived to be negative, it can be positive if the benefits outweigh the downside. At the end of the day, the lifeblood of your business is going to be to keep it cash flow positive. I believe the goal of risk management is to make your organization strong enough to continue taking daily risk connected to operations. If your organization can manage this risk well enough, it would allow you to take on larger projects, expand product offerings, or improve employment packages. These benefits would allow you to see bigger returns and retain the best people. Mark Twain says it best, the greatest risk is the risk not taken. Your business is subject to many various types of risk. However, we are looking to make sure none of these result in a loss. As we look at the types of risk, we can really get an idea for what may exist. Insurance professionals often insurance professionals often focus on hazard and accidental risk because they can be addressed by insurance. These would include things like fire, theft, or customer slip and falls. Reputational risk, on the other hand, cannot be insured by a policy. If a large segment of your customer base goes through a bad experience, you can't readily replace those experiences with a good one and restore your reputation back to its original status of greatness. So business risk is an all-encompassing risk, focusing on all aspects that could shut your business down. This could be an increase in competition, a downturn in the economy, or a supplier may even suffer a loss during a critical time of the season, causing delays in shipments. Emerging risks are those risks that are in the future that have a high level of uncertainty and that we're not 100% aware of today. With that being said, I would like to highlight the fact that risk is always evolving, and maintaining focus on what threatens your operations is an ongoing process and essentially a labor of love. While there is truly not enough time to go through each one of the risk management objectives in the 5 steps and the 6 steps, I do want to give you kind of a high-level view of what the process looks like. So the first step in risk management is identifying loss exposure within 4 key areas. Now, this is specific to property and casualty. So those 4 key areas are going to be property, liability, net income, and personnel. So we're looking to identify frequency and severity of these exposures. Essentially, we're asking how often do they happen and how bad are they when they do. So after reviewing exposures, the goal is to implement techniques that focus on risk control, risk retention, and risk transfer. And I'll kind of explain at the end what all those mean. They're sprinkled throughout the whole presentation, but for clarity. Now, what if you're a new business owner, new to an industry, or simply don't know the risk of a particular industry? How do you get started? Well, one of the best techniques for identifying loss exposures is through surveys and questionnaires. These targeted questions are drafted by experts that are specific to one industry. For example, let's say you're opening a daycare. The largest liability exposure would be that of injury or death to a child and various abuse and molestation allegations. So the questionnaire would ask a number of questions about who's running the daycare facility, their experience in the industry, whether you require background checks during the hiring process, rules that are in place, first aid training, procedures for dealing with emergencies, and protocols for parental waivers and contact information. Other questions associated with loss exposure would focus on the other areas being property, personnel, and net income loss. The good news about these questionnaires for the majority of industries is that they've already been pre-drafted by most of your insurance carriers, which would classify as one of the experts in the field. Your insurance broker works with you in filling out these questionnaires before a commercial insurance policy is ever issued. Ultimately, the insurance carrier wants to know how safe your operation is and if you're focused on managing your risk. Answers on these questions can help underwriters price your policy and identify if your business is safe enough to fit within their guidelines for insurance. If your business is currently insured, you may have filled out one of these questionnaires before. They can be lengthy and pretty broad, and you may have been thinking, are all of these questions necessary? In reality, if you go back and take a look at those questions within the form, it can be a highly valuable tool from a risk management standpoint. Questions in these forms can help you highlight areas of your operations that you didn't think of yet, but may need to be focused on for improvement. Other techniques in identifying loss exposures include loss histories. So loss histories are just the history of how many losses you've had and how bad they were in regards to cost and injury. So if you're a new business, you won't have any loss history. However, you might want to network with other companies within your industry to find out about their experiences. So this is a highly valuable way to help your company prevent or mitigate its own losses because history does tend to repeat itself. So in total, there are 6 techniques in controlling risk. Avoidance. Now, this is a pretty extreme technique because it would require you to stop all activities that have the possibility for a loss. So for many businesses, that just isn't a feasible way to make money. So loss prevention. Now, this is a method used to reduce the frequency of a particular loss. A construction company will conduct safety meetings to help reduce accidents leading to employee injury. Loss reduction. Now, loss reduction isn't stopping the loss, but it's reducing the severity of it. So installing a sprinkler system in a building will not stop a fire from starting, but the emergency water system will reduce the damage caused. Separation. Now, this one is spreading out your activities. It requires you to spread out your activities across multiple locations, or if your organization isn't that large, it would also be diversifying your product offerings to help increase revenue from one area and supplement operations of another area. For example, did you know the Las Vegas Valley Water District owns beef and sheep herds that produce revenues close to $1 million? Duplication. If your business must keep operations running during a downturn, duplication is the process that will help keep that going. So hospitals, for example, will use backup power generators, while banks will have backup computer systems. One of the nice things about today's arena is that we've got a lot of advances in technology, and one of the areas that will really help duplication is cloud computing. Cloud computing will allow you to access your files pretty much anywhere in the world. So, the last step in risk control is contractual risk transfer. Now, insurance is a form of contractual risk transfer, which is the final technique, and can be used in combination with some of the other risk control tools as well. Now, the beauty of affording a property and casualty insurance policy through a carrier is that you don't have to set aside a vast sum of money in case of a loss. Typically, if you're self-insured, you've got large sums of money set aside in the event of a loss. That way you can pay it without having the coverage, and that's what essentially happened in the mid to late 80s. So instead of setting aside a larger sum of money, you're able to set aside a smaller fund to pay annual premiums and deductibles. The money that you would otherwise, be using that would be stalled in your self-insured fund can now be free to invest into product range diversification. This would allow your company to once again generate additional revenues like those accumulated from the Valley's Water District herd of animals. So depending on the contractual language of your insurance agreement, insurance companies will also pay lawyer fees in your defense. They'll replenish your property after loss and, of course, cover medical bills. Still, having reserve funds is never a bad idea. If the benefits outweigh the risk, self-insuring can still be a viable way to manage costs, even in an ideal insurance market. So I believe risk will always outpace insurance, as new risk can appear overnight, whereas insurance needs time to address the impacts and assess the scale of the exposure. With that being said, there's still a vast wealth of insurances that are just as varied as the many risks that are here on the market. A common theme you'll see in property and casualty insurance is that of property and liability. Most business owners know of general liability, but may not be familiar with some of the other forms of liability that exist. For example, a professional liability policy may be purchased by an architect to cover issues arising out of flaws in their designs. Doctors may also purchase a form of professional liability classified as medical malpractice for liability arising out of maybe mistakenly diagnosing something and issuing the wrong prescription or medication. Property, on the other hand, looks to address two types of property, and these are going to be real and personal property. So I like to think of real property as anything that's an immovable object, something that's kind of structured to the ground or the ground itself. This is going to be things like land, buildings, or other large structures. Personal property is anything that is movable and is not real property. So this is going to be your laptops, cell phones, furniture, inventory, and all of those items. They all fall into that category. So when you're thinking about your liability and property exposures, here are some questions to consider when trying to formulate a risk strategy. So how much interaction do I have with the public, and do they come to me or do I go to them? Does your profession require you to have a license, and is there a governing body that regulates your industry? Do you give any form of advice? A good example of this may be a life coach who's not regulated or licensed versus a clinical therapist that is regulated and licensed. Are there measures in place that prevent you from taking a certain form of liability like those of nonprofits under various state laws? And then what about employees? One of the biggest compliance risks facing employers right now is that of the 1099 independent contractor. The state of Nevada is cracking down and auditing and finding many businesses that are classifying employees as independent contractors. Have you had an expert review your for-hire work structure to make sure you're in compliance? How much property and inventory do you have? Pens, paper, and paper clips count too. If your building was to burn down today, what would it cost to replenish all of your real and personal property? What would your plan of action be during the rebuilding phase? Would you temporarily relocate or shut down your operation completely? What would it cost to continue paying for bank loans and employee wages? Essentially, looking at your organization and asking more questions like this can really help you in the process of identifying your risk management strategies. In regards to the 6 risk control techniques that we spoke about earlier, it is important to keep in mind that not all techniques need to be used. In order to select the most effective technique, there are 2 criteria to consider: finances and business objectives. So I recently worked with a nonprofit that takes veterans on hunting excursions around the U.S. and Canada. One of the risk control techniques that was utilized was risk transfer associated with liability. By working with a lawyer, the nonprofit was able to produce a waiver of liability that protects their organization from assuming risk for injuries that occurred during participation. Now, this is an initial cost that they had to pay the lawyer up front in regards to drafting that document, but the financial burden associated with being sued outweighed the cost of paying the lawyer. In effect, when considering which method of risk control you want to use, a budget should be set aside to help you identify where funds should be dispersed. Your business objective will help you plan on how to disperse those funds. So if one of your objectives is to retain and recruit the best employees, ongoing risk management efforts could be identified to support the cause. So here are a few risk control techniques in action. Issue employee handbooks and safety manuals that have an employee sign off. Now, this is great for not only the business, but for the employee. For the business, it helps mitigate employee liability, which, maybe if you do have to let somebody go, they say, well, you fired me because you said I was fat, and that wasn't the case. So you have them sign off and say, hey, we don't discriminate or do anything like that. And it helps build faith in the employee knowing that they're walking into an organization that's got structure. Now, one of the things that I see often, and this is to do with reputation, and it's rampant online, you'll see a business who's got a Yelp or a Google listing, and on that listing, they'll reply to all the positive feedback that they've gotten, but then they'll go and ignore all of the negative comments. Part of your risk management strategy could be to reply to all comments. Because it is your online reputation, any response shows good faith. So conduct employee background checks before an employment offer. Clearly place warning signs in areas that are wet, slippery, well-polished, or even elevated, such as steps or raised concrete. Even walking into the chambers today, I saw be careful by the step sign. So the benefits of risk management for your organization can be huge. For one, I think risk management is the best cost-saving tool when it comes to reducing your insurance premiums. This is especially important for businesses that have filed claims within the past 3 years. This means you are currently paying, if you filed a claim in the past 3 years, this means you're currently paying a raised premium, and without a risk management strategy, your insurance carrier will have no idea what it is you're doing to better your outcome. Brokers like myself should work closely with their clients in order to help them increase their awareness and decrease their cost. Other major benefits to risk management is reduced worker comp employee claims. This can be huge, especially if you're a construction contractor. When large organizations take a look at your bid history and the quality of work that you provide, if they find that your claims are inconsistent with market trends or their guidelines for risk, they'll deny your bid even if you're the lowest. This can have implications, once again, on your reputation, which has to be carefully managed. Of course, one of the major final benefits is the fact that you keep your business running cash flow positive even in the event of a downturn. So, getting started with risk management, here's my recommendation for getting started with a platform today. First, identify company goals, Identify company goals so you have a strong sense of where you want your program to focus. Next, find an expert. Now, experts can come from anywhere, being internal or external. In fact, you may be the expert along with you. You may have an employee who's an expert in their role, in their particular role. Businesses often employ third-party experts such as risk advisors, accountants, or lawyers to help them identify and establish rules. These rules can also be backed by protocols, plans, and various elements that help benefit their organization. Of course, identifying the risks. So use your expertise along with your internal or external experts and identify the risk that could be, reputational, hazard and accidental, financial, or business. But start by finding the areas that could hurt you the most and zero in on those first. Ask your insurance broker for a questionnaire specific to your industry and network with those other businesses that have that similar exposure. You also want to brainstorm which risk control methods you would like to use based on your company's goals and budget, and then combine those strategies and roll them out within your organization. Monitor the results because, monitoring will let you know if your plan's working in your favor or against you. Now, even if you're, haven't had any losses, you still want to monitor the success of not having losses because that's still a big plus for your organization. But last but not least, report your success to your insurance broker because your broker can essentially go back to your carrier and pretty much market your account as that much more safe and apply credits to your policies. And depending on how your structure is, if you've got other members or partners that are also a part of the organization, you'll also want to let them know where the funds for your risk management plan, how they're being spent. Is the plan working? Is it something that we need to even focus on, or is there a way for us to still reduce costs along the way? So essentially, this is the end of my presentation. Thank you all for joining and being a part of it. Was there any questions from anyone who has called in?
I have just one question.
Yeah.
So because the Chamber has such a diverse group of small businesses and large businesses, what would you say each should focus on in regards to risk management? Like, what are the differences in risk between small and large businesses?
I think reputational risk is going to be just as important for any size. So I would definitely focus on that, and then liability is going to be the biggest risk for most businesses. Usually when you see a general liability policy, it is the injury that could be incurred by a client or somebody who's visiting your facility. So if you have a facility, if you're out in the field or wherever the case may be, you want to make sure and have that general liability kind of policy in place first, and then some of that stuff, like managing your reputational risk, that doesn't necessarily cost anything if you do it well, but you could also hire a PR firm or something like that to, manage it with you.
Awesome. Well, I want to thank you so much for being our presenter today. Super informative, and thank you all for listening in today. And again, if you guys have any questions, I'll leave this up here. I think this is contact information. So you can get more, contact Daniel, contact Distinctive Insurance, or you can contact the Chamber, and we'll get you guys in touch with him. And thank you so much again. And no Chamber University next week because it's Veterans Day, but we'll see you all in 2 weeks. Thank you.
Awesome.